Assalamualaikum class. In this lecture, we are going to cover a very frequently asked question in the exam, which is related to doubtful accounts or uncollectible accounts. This problem is problem number 7.3a from Williams Haka Bettner's book Financial and Managerial Accounting, chapter 7. This problem also has aging method. We are going to cover aging of accounts receivable. So what is aging of accounts receivable? It's simply aging, simply distinguish open accounts receivable based on the length of time, or you can say the duration of time an invoice has been outstanding or remains unpaid. So you can see in this chart or in this table, we have divided total accounts receivable into different groups, and the first group is not yet due. The second group is 1 to 30 days past due. The third group is 31 to 60 days past due. Means the whole amount is divided into uh, different group based on the length of time the amount remains outstanding. So the company is a superstar Hollywood publicity firm, uses the balance sheet approach to estimate uncollectible accounts. Uh, in lecture 3 related to chapter 7, we have discussed two approaches related to calculate uncollectible amounts. One approach is income statement approach and another is balance sheet approach. In income statement approach, simply the percentage of uncollectible amount is given. We simply apply that percentage to the sales, and from that amount we pass journal entry. Whereas in balance sheet approach, we will have to calculate the uncollectible amount, the current uncollectible amount, and then we will have to adjust it in any existing balance, any existing balance of allowance for doubtful accounts. So this is the balance sheet approach. Please refer um, lecture number 3 for the detailed explanation. At the year end, an aging of accounts receivable produced the following five groups: not yet due, 1 to 30 days past due, 31 to 60 days past due, and so on and so forth. So the total amount is 8,35,000, which is divided into five different groups based on the time, or you can say length of time. So I have just copied this chart in the Excel sheet for further calculation. Based on the past experience, the company estimated the percentages probably uncollectible for the above five age groups to be as follows. Means these are the outstanding balance of accounts receivable, and based on the past experience of the company has calculated or provided five different percentages, and these percentages apply to these groups. Like for group A, 1%. So we are going to write down these are the chances that amount remain uncollectible. Probably, or you can say probability is given for uncollectible amount. So the 1% is the chances that group one, group A. Here you can say A, B, C, D, E. So these are the five groups. So for group A, you can see uh, 1% is the chance that this amount remain uncollectible. So for group A, 1% is given. For group B, 3% is given. Then for group C, 10% is given. For group D, 20% is given. And the last one for group E, 50% is given. As we have just discussed in the very start of this lecture, that the older the receivable is, the harder it is to collect, or the harder it is to convert that receivable into cash. So that's why, as the The past due amount are older and older, the percentage of uncollectible are more than that the previous one. So if the amount is not yet due, the percentage of uncollectible is 1%. Then we have 3%, then 10%, 20%, and then 50%. So there are only 1% chances that the 500 or you can say out of 5 lakh, only 1% will be uncollectible. So these are estimated amount, these are not 100% sure, so that's why we pass this amount as provisions. How we are going to calculate it? We simply multiply 5 lakh by 1%. Then when 2 lakh 10,000 are 1 to 30 days past due. So 3% are the chances that this amount will not be collected. So we are going to apply uh, this percentage on 2 lakh 10,000. So these are, you can say these are estimated uncollectible expenses or uncollectible amount for 80,000. The estimated uncollectible percentage is 10%. So we multiplied by 10%. Then for 15,000, which is 61 to 90 day past due, there is 20% chances that this amount will not be collected. So we apply this 20% here. Not This is 15,000. Then for the last, which is over 90 days past due, 30,000. So we multiply 30,000 by 50%. Okay, by 50%. So the total estimated uncollectible amount is 37,300. Out of 8 lakh 35,000, it is estimated that 37,300 will remain uncollectible. So this is the answer of requirement number A. What was the requirement number A? Compute the estimated amount of uncollectible accounts based on the above classification by age group. So by age group, we have calculated estimated uncollectible amount or expense, which is 37,300. We simply apply these percentages with the amount given with the different length of time. So amount is 37,000. So second requirement is prepare, you can see, prepare the adjusting entry. So we are going to pass an adjusting entry needed to bring the allowance for doubtful accounts to the proper amount. So uh, the adjusting entry is simply uncollectible accounts expenses debit and allowance for doubtful accounts is credit. But the main thing is to calculate the uncollectible amount. So because we are using balance sheet approach, so we cannot pass entry by directly any amount. We will have to adjust it from the existing balance. So here you can see that it, as it is the balance sheet approach, so we will have to search if there is any existing balance of allowance for doubtful accounts. So you can see The allowance for doubtful accounts before adjustment. Before adjustment means before making or before calculating this amount, the already, or you can say the existing balance is 11,800, and this is a credit balance. So the credit balance, so we are going to calculate, or we are going to find out the amount from which the current entry will be passed. So the method is, simple method is, we have required, or you can say estimated, estimated allowance for collectible. So we have calculated how much amount? This one, the one which we have just calculated. You can take it here. So the amount is 37,300. The next step is simply we deduct any existing, or you can say before adjustment balance of allowance for doubtful accounts. Before adjustment balance, so we have a credit balance. So if we have any credit balance of existing allowance for doubtful accounts, we simply subtract or deduct it from the this estimated amount. So we deduct allowance allowance for doubtful debt counts before adjustments. So the amount is 11,800. This amount is before adjustment. So we deduct it from the estimated, or just we have calculated this amount uh, by deducting 11,000 from 37,300, we get 25,500. So this would be your current provision. Current provision means we are going to pass the adjusting entry by this amount. This I'm going to highlight it. So for adjusting entry, we have date. We must have date. Date is 31st December. So one column is date, accounts, titles. Then we have a debit column and a credit column. So the date is the end of the accounting period or accounting month. The end of the month is December 31st. Accounts title, uncollectible accounts. Expense is on the debit side by the amount we have just calculated, 25,500. And the the credit side would be allowance for doubtful accounts by 25,500. So this is the adjusting entry as on December 31st. We have arrived this amount by deducting existing credit balance of allowance for doubtful accounts from the amount we have calculated by aging method. If we suppose it is in this problem, it is a credit balance. Suppose we had a debit balance. So instead of deducting, we add any debit balance from any debit balance from the estimated uncollectible amount. So this would be the requirement B, and requirement C What is the requirement C? Assume that on January 10th, so we are talking about January 10 of the following year, Superstar learned that an account receivable that had originated on September 1st in the amount of 8,250 was worthless because of the bankruptcy of the client, April Shower. So April Shower was a client who become bankrupt. So the amount which is receivable from this client become worthless or uncollectible. Or you can say we are going to simply write it off. Prepare the adjusting entry required on January 10 to write off this amount. Write off means we are going to completely, you can say, close this amount or close this April showers account. So the entry would be the date is January 10. Usually, allowance for doubtful accounts is a credit balance. Now we are going to close this account, so we send it to the debit balance. So allowance for doubtful accounts will be debited by how much amount? The amount which is due by this client, April Shower, and the accounts receivable will be on credit side because we are going to close this account. So accounts receivable by nature is a current asset account, and whenever we close any current asset or any asset account, we send it on the credit side. So that's why accounts receivable is which is related to April shower is on credit side because we have closed or write it off that account. Now, the entry or the requirement number D. The firm is considering the adoption of a policy whereby clients whose outstanding accounts become more than 60 days past due, or you can say remains outstanding for more than 60 days past due, will be required to sign an interest bearing note for the full amount of their outstanding balance. So, this is the company policy. The policy is to sign a interest bearing note for those clients whose amount remain outstanding or unpaid more than 60 days past due. What advantages would such a policy offer to this company, means to Superstar company? I think there are two advantages. The first advantage is uh, it will boost or it will induce the client to pay within 60 days past due. Why? Because after that they will have to pay additional amount. I mean, it if they won't pay within 60 days, then they will have to pay additional amount in the name of interest. So it is this policy may induce or may boost the client to pay within 60 days time. The second advantage is to the super company, or is that the company will get additional income, or you can say interest income. So interest income would be the second advantage for that company. So that's it from this problem. Take care, class. If you have any comments, please um, comment on the video, ask any question. Uh, okay, class. That's it. Take care, class.